Welcome to Tampa Home Talk with your host, native Tampa real estate girl, Katrina Madewell, a full-time, passionate, out-of-the-box thinker, love for home ownership kind of realtor with over 21 years of combined mortgage and real estate experience. Tune in every week at this time for expert advice on everything you need to know about home ownership, finance, maintaining great credit, building wealth, and making your everyday life better, and how you can be financially successful today and tomorrow. Remember, love where you live or let Katrina fix it. Now, here's your host of Tampa Home Talk, Katrina Madewell.
Good afternoon, Tampa Bay. This is your host, Katrina Madewell, Charles Ruttenberg Realty. Thank you so much for joining us again this afternoon. We hope to make your drive time home or time out in the car a little bit better today. Every week, we strive to bring you some fantastic guests, some great advice, and share a little bit of the insight that we deal with every week. So this week, I thought I'd share a little bit on some of our real estate follies, and Lord knows we have enough of them every week. It's just part of the industry that we can experience, but I got to tell you, we know how to handle it, and that's what we do every day. So the goal of our show here at Tampa Home Talk is to help you keep and maintain good credit, or maybe even get it up to par, live within your means, and build wealth. And my team and I are absolutely passionate about that. So I have some guests joining us a little bit later in today's show. Lorie Zoock is going to be joining us for our Credit Crunch, and Sarah Crickey with Silverton Mortgage is going to be joining us for our Mortgage Minute. And we also are going to have Andrew Feinberg. He's a columnist for Kiplinger. He's going to be joining us for the Money Matter segment a little bit later in the show. I've got some great properties I want to share with you today that are not on the market yet, because it's a very hot market out there, and we know that stuff's going fast. And a couple of the properties that we have available are not actually in MLS. You won't find them on Zillow or Trulia or any of those places. So listen up for details on that, and we'll give you some information on how you can get in there ahead of the multiple offer situation. Next week in studio, we're also going to have Ricardo Gonzalez with Sabadell Bank. Excellent banker here in the Tampa area. He offers a little bit different of a product than most if it comes to jumbo money, meaning you want to get a mortgage and you need to be over that threshold where you're put into a jumbo category. They have excellent products. Anything you can think of, they have it, from fixed rate loans to adjustables and a lot of creative financing type stuff. They also do a lot of loans for foreign nationals. And when I say foreign nationals, for example, whenever you're here in the United States, you have to be a U.S. citizen to buy and get a conventional loan, or at least have a green card, your permanent resident alien card. If you don't, then Sabadell Bank has an alternative for you so that you can still purchase a property and you won't have to pay cash. So, as promised, I've got a property coming up in Fishhawk. Excellent little city home with the 2-car garage in the back. It's got 3 bedrooms, 2.5 baths. It's over 2,000 square feet, built in 2005. Absolutely stunning property. It's gorgeous. That's going to be listed for $225,000. You can catch it at tampahometalk.com once we post it live, and we're going to send out a little pre-tweet at Tampa Home Talk, as well as our Facebook page, Tampa Home Talk. So you'll be able to get a little sneak peek of that. This house is fantastic, and what makes it really special is that it's in the Garden District, right there in Fishhawk, and it's near Park Square and the Aquatic Center. You can walk to A+ rated schools, literally just minutes. You don't even have to get in your car. So that's city living in the middle of, just absolutely peaceful God's country. Also, I wanted to talk a little bit about some of the things that we encountered this week with regards to a shared road maintenance agreement. I'll get in that in a few minutes. And I'm also going to talk about the Ellie Mae shutdown and what that means for you and how that can affect everyday consumers. It ties in very much so with a similar situation that happened with Target and their security breach. One more property I want to tell you about. Haven't listed it yet. It's a rental, and it's in the Trinity area in Thousand Oaks, a little townhome, 3-bedroom, 2.5 bath, a little over 1,500 square feet, just $1,200 a month. And you'll be in A-rated school zones with that one, Mitchell. So this week, I got to tell you, we see all kinds of stuff. And so we had to track down a shared road maintenance agreement. And you might be thinking, what the heck is a shared road maintenance agreement? And I got to tell you, it was fun. It was interesting. It's not something we see every day. And usually if the lenders are going to ask for it, they usually ask for it in advance. Well, this one kind of popped its ugly head up a little bit late in the game, but that's okay. We expect that kind of stuff. And what it is when you have a road that leads to a home, which obviously was the case here. It's not a county or city road, meaning they maintain it, take care of it, fill any potholes and that type of stuff. Rather, it was just a gravel road. And the gravel road was actually owned by one of the adjoining homeowners or adjacent homeowners, kind of county corner across the street. And the property is actually hers, and there's an easement on it, which allows the homes in the back to drive to their home and get to it. There's a little thing called right of ingress and egress in our Florida statute that says you have to have an ability and a right to get to them from your property. It's in the Florida statute. It's also in the mortgages anytime people sign a mortgage. And so what happened was this particular road was a dirt gravel type road, and obviously not maintained by the city or county, a little bit more rural area of Tampa. And there was another neighbor that, when you went to the end of the street, 4 houses on this road, one on the left, one on the right, which was the street's actually owned by the neighbor on the right. Then you keep going, there's 2 houses, one on the left in the back where my client was buying, and the other one to the right. So you go to the end of the street, literally you can turn left or right and you'll be in a driveway. Well, they do this because there's a couple reasons. They don't want people, blocking or obstructing the roadway. And for example, Betty, the person that owned this road, technically could, even though there's an easement, but it would get into a litigation type thing. So that's why lenders are asking for that. We haven't seen them be so strict on that in the last several years, but I have to tell you that in the last 5 years or less, we've seen them ask for that on numerous occasions. So the shared road maintenance agreement, I had to basically go out and meet my client's new neighbors, which I like talking to people, so it is really good for me. But I had to go out and introduce myself, explain to people that, the buyer's lender needed this shared road maintenance agreement signed and notarized by all the neighbors so that they would all keep and maintain their portion of the road and not obstruct it and really just take care of the road because the county or city wasn't there to do it. So that was fun because I got to meet some new people right before closing, and it got held up. And of course, the seller wasn't happy about that. But those are one of those little hiccups that we encounter in our business every day. And we call that turbulence. And that's our, in our short list of 88 types of turbulence that we like to refer to. Our studio call-in lines, in case you're listening, you maybe have a question about the shared road maintenance agreement or want to connect with one of my guests on the show today, is 727-441-3000. You can also find us at tantalk1340.com, 727-441-3000. And the other thing I want to touch on too, because we saw that as well, is post-occupancy by a seller, and explain to you what that means. And, for a buyer, if there's a delay, like for example, with this shared road maintenance agreement, it was delayed for a couple of reasons. One was the Ellie Mae thing, which I'm going to get into in a few minutes. And the last hiccup was that shared road maintenance agreement. What happens is essentially they, the buyer's anxious. They a lot of times have moving trucks lined up. They're ready to move in, but for whatever reason, their lender's holding it up until they need the final missing documents so the loan can be saleable. For example, the shared road maintenance agreement. So a lot of times, buyers will ask about a pre-occupancy, meaning they want to move in before the property actually is theirs. It still belongs to the seller. Or we even see post-occupancies by a seller. So I'm going to explain to you a little bit about what that means, why attorneys don't like them, why we don't like them, and essentially what the situation is with them. So for example, on this one, in this case with a pre-occupancy by buyer, if the buyer were to move in, and let's say hypothetically speaking, and this was a scenario the attorney gave me and I thought it was a very good relative example, if they were to cook dinner on the stove or whatever, and they light the house on fire and they burn it down. Essentially, at this point, you're going to have insurance companies that are going to be fighting out whose liability this is. And then they're going to say, the courts are going to say, well, it's hard for us to define their relationship because the contract to buy and sell likely may be expired by that point. And there's not a lease in place to define their relationship as landlord and tenant. So that's why, it's a big reason why, if they have someone that comes and moves in their moving truck, they fall down, they get hurt, they break something, God forbid they die. That's potentially a lawsuit for the current owner, which is the seller that was trying to be nice and let a buyer move in. So there's a couple of reasons why we don't like pre-occupancies. It's not because anyone's being mean. There's a lot of legalities and technicalities behind that thing. Post-occupancy, biggest thing we run into here where seller wants to stay a little longer is what happens if they don't get out? And we have sellers, a lot of them in this market that are short sales, for example. And let's say, they've been living rent-free for 6 months, 12 months, in some cases, several years. And if these guys decide, they like not having a mortgage payment and they don't want to get out, you're going to have to go through the eviction process to get that seller out. So, it's a very fine line if you're going to do either a post or a pre-occupancy by buyer or seller. Our suggestion is to always have a lease in place that specifically acknowledges that and outlines the terms of your other contract. And if for some reason it doesn't happen as it's expected to, there's a clause in there about them vacating. And then, of course, you always run the risk of damages from the people that were occupying the home, whether it's malicious damages on the intent of a seller that did a post-occupancy or someone else. Last thing I want to touch on was Ellie Mae shut down, and this happened just after the first, actually. Happened a month in, so it pushed some closings back for us as well. But Encompass is a proprietary mortgage software that a lot of mortgage companies use. I would say more than 20% of mortgage companies use Encompass nationwide, and their system was actually hacked. They didn't want to come out and say it, but they were hacked, breached, just like Target and many of these other places, the IRS. I mean, there's numerous places where their system has been hacked. And essentially it shut their whole thing down, so that it hindered the ability to draw docs to get loan approvals. So, buyers that were waiting for packages to actually sign those loan documents couldn't close escrow. So it sure created a little bit of havoc for us at the earlier part of this month, but they're back up and running now, and thank goodness for that, because it sure did create some havoc. We'll have to take a quick break here, but we're going to be back in a few minutes. You're listening to Tampa Home Talk. When we come back, I'm going to talk about the FHA Back to Work program, and this will affect you if you've ever had a short sale, foreclosure, deed in lieu, and you would like to repurchase again. Stick around. We'll tell you about FHA Back to Work program in a few minutes. Tampa Home Talk, back in a moment. Welcome back to Tampa Home Talk, and this is your host, Katrina Madewell, this afternoon, hosting you. I'm a realtor with Charles Ruttenberg Realty, and this show is brought to you by Real Estate Radio Network here on Tan Talk. So I have a special guest, Lorie Zoock. She's calling in today to do our Credit Crunch segment, and every week we're going to bring you a little tidbit about your credit and things you should know, and little things just to help you keep your credit good, rebuild it, or get it where it needs to be. Lorie, good afternoon. Thanks for joining me for Credit Crunch.
Thanks for having me, Katrina. I'm going to give you your listeners a little tip today. When they review their credit report, the most important thing before you even look at the credit lines is to review all of the personal information on the reports, meaning check that the names are all your names and not variations. Make sure you actually lived at all of the addresses. And also check to see if there's more than one Social Security number, because sometimes files can be merged with other people's files. And especially that's common when it comes to juniors and seniors.
Absolutely. We've seen that a handful of times, more than a handful of times in our business. Hey, so let me ask you, if there is a variation of the social, or there's more than one social, or with what you mentioned, maybe there's an address, say, that doesn't belong to you or you've never lived there. How does that affect someone listening, and why should they care about that?
Well, they should care because it means that most likely, unless there was a typo made, if they see a lot of errors, chances are they have what's called a merged file, where the credit bureaus, you think that they're pulling it based upon your name and Social Security number. However, their databases pull similar information, which is how other people with similar names or information get onto the report. Now, typically the credit bureaus won't acknowledge that it's a merged file, so the easiest way to solve that is actually to do an identity theft affidavit.
So you're telling me, like, for example, I may have, use myself, for example. My name's Katrina Madewell, but there might be someone else with the name Katrina Maxwell. Is that what you're saying?
Right, or maybe there's a Catherine Madewell.
And their socials would be similar?
Well, their socials might not, but the names may be similar.
Gotcha.
And you'd be surprised how many people, when I tell them to Google their own name, find that there are 20 or 50 or 100 other people with the same name.
As surprisingly unique as my name is, there are other people with my name.
Yeah, well, that's so that kind of gives you a hint. Unless you have a very, very unusual name, it's very possible that your file could be merged.
And so the best tips to do that, should they start by writing the credit bureaus, or should they actually file the identity theft if they think, just for an address, you think, let's say they look at the trade lines or the repositories, the items actually being reported, and let's say there's nothing funny there and nothing looks any different, or there's no accounts that aren't theirs, everything on there belongs to them, but there's an address somewhere that they've never lived or out of state, they should still be concerned with that and get that off?
Yeah. They should still be concerned with that and get that off, because if it's not their information, it shouldn't be on their report. So I will tell you there are some exceptions. Sometimes if they were married and they're divorced, it may show up with the address of the ex-spouse, especially if it was a joint cardholder account, for example. But if they don't recognize that address, or it's in a state they've never lived in, then they need to send a letter to the credit bureaus, or actually they can call them and say, this is not my address, I want you to remove it.
Are you finding that the credit bureaus are removing those, or does it take a lot of effort on the consumer's part?
It usually takes a lot of effort on the consumer's part, unfortunately, but what they can also do is they can contact the Consumer Financial Protection Bureau and file a complaint with them, who in turn will then contact the credit bureaus on their behalf. And because the Consumer Financial Credit Bureau is a fairly new government agency, they apply a little bit of pressure, so it may actually work better for the consumer to contact them first, and then they'll contact the bureaus, and then they'll get a response back.
And so any variations to the name, same type of thing? Just respond and say, hey, I've never been known by this name, or there's a misspelling, or there's a typo.
Right, that's correct. And if they're telling you that that's how it was reported, then ask them what company is reporting it that way, and contact that company and make the correction through that company so that it appears corrected on your report.
Gotcha. That is an excellent tip, Lorie, because I think a lot of people, including myself, we get our credit report every 6 months or every year or every so often, even whenever you look at it, even if it's been a couple of years, you're going to have a look at that. You're going through the items on the credit report to see what they are and make sure they're yours and they're reporting correctly and there's no lates. Like, that's some of the big things that people are looking for. But I would imagine, because I'm guilty as well, and I look at hundreds of credit reports on a weekly basis, and I'm guilty of skipping over that personal information section in the front that you're talking about.
Right. It's funny. I work with a lot of realtors, like yourself, and a lot of mortgage people, and a lot of times that's not really their strength. I mean, some of them know a lot about it, but they're really looking for the FICO scores and how can they get that deal closed. So they may not be looking, but what's funny is a lot of times the consumers themselves are not looking at that same information. They skip right to the credit lines to see what's on there, but they're not looking at the personal information because they don't understand how common it is for a file to be merged with somebody else's information.
Now, how do you think the credit bureau, how do you think that happens? Do you have a theory on that, or do you know?
I suspect that I kind of know. I know that when they pull the information from their databases are set to look for similar information to put on your report. And the reason why, is that the more they would rather put more information that might be you, even if it's wrong, because it drops your scores, as opposed to having an actually correct file where it's all yours, but the information might not be as bad, and therefore your scores will be higher. Because keep in mind, it's the banks that basically subsidize or pay the credit bureaus to report to them. So that's the reason why.
And it's up to you as the consumer to fix your credit and make sure that it's in order. I mean, no one's going to do it for you unless, of course, you reach out to Lorie and you pay her. Then maybe she can help you out with that.
Well, that's what I do. I actually teach credit. I make sure my clients understand how it works. It would be great if I could do that before they get to the I want to buy a house part.
Right.
But a lot of times people don't do it until they have their credit pulled and go, oh my gosh, what is that on my report? And, that's where the troubles begin.
Now, Lorie, I know there's a lot of busy professionals just like me that just don't have enough hours in the day, it seems, because you're trying to exceed your client's expectations or, put the task that your boss put on you or whatever. And so what about busy people like that have inaccuracies? Can they pay you for a fee to help fix that stuff if they give you the information and kind of give you the ball and let you run with it?
Yeah, I mean, just briefly, pretty much I do a two-step process. I charge a flat fee a small flat fee to basically analyze their reports, send them a spreadsheet, and do a telephone consultation and explain to them what their report says about them, and then give them the opportunity to tell me if it's accurate or what happened in their specific case on each credit line. Sometimes I can just tell them what they need to do, but more often they need to go to the second step, which with me is a 90-day process, and I'm teaching them and providing them the information so that they can go ahead and resolve the issues themselves, but they can come back to me at any point during that process and say, I need help. Because my goal is to not just help them get into a house, but to stay on track and have good credit scores, high credit scores, and that's what...
Much like the goal of our show, Lorie, we really want to help people keep and maintain good credit or rebuild it, wherever they're at.
Right. You want those low interest rates. You don't want to be $15,000 in debt and paying 25% interest on credit cards for the rest of your life. And that's what happens for a lot of people. They get into trouble.
Again, that's within our show's mission. We certainly are all about keeping and maintaining good credit, living within your means, which is what you're talking about. And then the next step in life is just to build wealth.
Right. Exactly right.
Thank you so much for sharing with us today on Tampa Home Talk about the personal credit information, looking for merged files. It's an important tip. I appreciate the Credit Crunch tip of the day.
Thanks, Katrina. Good speaking with you.
Thanks. Have a good day. So I know we're going to have Sarah Crickey joining us here shortly. Cedric, is she already online with us?
And she is.
Okay. She's calling in about our Mortgage Minute. And so we're going to bring 2 little tips, a little bit shorter each week, but I thought I would familiarize our listener with the just slight changes to our show. We want to bring you Credit Crunch tips, short, little couple minutes or so, Mortgage Minute, and Money Matter segments. And so we have another guest from Kiplinger's coming up shortly in the show, Andrew Feinberg, which is a columnist actually for Kiplinger's Personal Finance, and he works with CJA Partners, and excellent walking book of knowledge. He's written 5 of them, so stick around. You won't want to miss him. And we're also going to talk about the FHA Back to Work program. So I'm not going to share that yet till after the break, but stick around and we'll tell you about FHA Back to Work and how you can buy a home, or at least think about going that direction if you've had a short sale, a foreclosure, or a deed in lieu. And you could do it a lot faster than you think, just after a year. Tampa Home Talk, this is Katrina Madewell, your host. I'll be back in just a minute. Stick around. Welcome back to Tampa Home Talk, and this is your host, Katrina Madewell, with Charles Ruttenberg Realty on the Real Estate Radio Network. Thanks so much for joining us today. If you missed any part of today's show, we got some great information that you might want to chime back in on and catch up. All of our shows are available via a podcast. Just search for Tampa Home Talk. And you'll find our Facebook and Twitter feed also, which are Tampa Home Talk. We talked about shared road maintenance agreement earlier in the show and what that means, and if you're on a dirt road or gravel road, and how it may affect you if you go to buy, sell, or even get a mortgage. And so we had Lorie Zoock join us earlier about personal credit information not being yours, like different people's information being merged with your credit file. So we have Sarah Crickey with Silverton Mortgage. She's actually joining us as well for our Mortgage Minute update today. And we're going to chime in on some things that we've actually seen this week. Hi, Sarah. Good afternoon.
Hi, Katrina. How are you?
Oh, doing fabulous. Thank you.
So in the prior segment, they were really going into some detail with regards to inaccuracies on a credit report, and how everybody beelines for that credit score and they look at the trade lines, but there's a lot of other data that the report contains that can be incorrect and should still be fixed. And all I wanted to do on that note is just chime in and say that in terms of the lending process, we do look at that information.
Well, it's important because,
Right.
You're speaking from a lender's perspective. You
Right.
eat, live, sleep, and digest this part of it every day. So there's nobody better than you to chime in on that.
Right. And what happens is if we see an address history, people move. They live in different places, and some people move from one state to another. But we will require that the client sign a letter basically stating if they ever lived at that address, for how long, if they ever owned it, if it was a rental, or if it was unknown to them. And so we put that in every file whenever we pull a credit report.
Does that just have to match the loan application within 2 years, or you're talking about ever? It could be 5 or 10 years ago.
I'm talking about going back that far, yes.
Okay.
Because, what happens is that, the loan application only requires a 2-year history, and we pull a credit report, and we see an address that doesn't match the address on our loan application that's 1 year old. So we certainly are going to address that, but they actually do go back that far. If multiple addresses are reporting, we will just ask on each one of them so we have the clarification.
Gotcha. And I mean, lenders can get fined so easily in this day and age with just with respect to how their I's have to be dotted and T's have to be crossed. So they're a little overcautious on this type of thing.
Correct.
So let's talk about employment not being disclosed properly on the 1003 or the mortgage loan application, because I know we ran across this week with a client, and it delayed his closing celebration.
Well, and I'll tell you what happened. The situation is that at initial consultation, we take a loan application that is supposed to be 100% accurate with respect to residency history, employment history, and it contains basically all of their personal information. This particular individual had, a period of time in 2012 where they were employed in multiple positions. They were working part-time jobs, contractor type work, 1099 type work, and it was for small amounts of money, and it was for short periods of time.
And this could be a lot of times, Sarah, let's just chime on this for a second and make it real to the person listening. So it may be they were in between jobs, or they picked up a part-time job or a second job.
It's very common.
Temporarily.
Exactly.
And maybe they're not there anymore. It was a year and a half ago.
Right, but to the actual borrower, this particular individual, it was such a small period of time and such an incidental amount of income that they didn't feel the need to disclose it. And so when we're taking a loan application, part of our disclosure package includes a document called a 4506T, and that gives the lender the ability to verify all W-2 income, all 1099 income, all tax return transcripts that were filed.
Yeah, period. Anything you're filing with the IRS, you guys are going to get it.
That's true. And so what they do is, they collect tax returns and W-2s at the time of application, but then they will still execute this document to verify that the numbers that they were presented with are what was actually filed.
Right. And this keeps down on fraud because, when lenders are defrauded, it increases default. And when people default, it costs everybody money.
There was a period of time, before, our industry had the trouble that it went through where they didn't execute that document on every file. They would only execute that document if there was a concern or a default on the loan.
Right.
But since we've gone through the meltdown that we went through, it is executed on every file.
The other thing, too, Sarah, and from my memory and coming from the mortgage world, many times I would have it executed at least at closing, but what we would see, it was only being the event of a random audit they could pull their tax returns.
That's exactly right, and it was in the event of an early default or a random audit. Now they execute it on every file. So in the case of this client, they got their W-2 and their 1099 transcripts back, and they said, whoa. We have income here with employers that aren't even disclosed on our loan application in the last 2 years. So it put everything came to a screeching halt. I basically
and the funny thing is, Sarah, that I would like to point out on this, it's not even like the client intentionally tried to defraud the lender or tried to not disclose any information or tried to hide anything.
Right.
It's not even like they added numbers to their tax returns or anything. I mean, they simply, it was just a tiny, tiny amount of income that was, a couple of years ago, didn't even think about it.
Again, like I said, the borrower didn't disclose it because it just wasn't a lot. He didn't feel like it needed to even be considered. But they can't decide that for themselves. They really just have to give us all of the information, and that way we can work with it, But in this case, no, the information changed.
So from a lender and an underwriter perspective, Sarah, I mean, obviously everything came to a halt on the file.
Correct.
The client didn't close escrow on time, but, from a lender's perspective, what are they thinking when there's information that pops up by way of a tax transcript from the IRS that wasn't disclosed on their initial loan application?
Every case is different. I mean, there are situations where, a tax return is provided, and maybe the tax transcript verifies a lower income. In that type of a scenario, they're really going to scrutinize it. because they want to make sure that the applicant isn't being fraudulent and overinflating their income.
Well, plus they've qualified them based on a certain amount.
Sure.
You know, with all the QM or qualified mortgage guidelines, if those debt ratios are tight, that can create havoc.
Sure. And in some cases, it's completely innocent. I mean, the applicant just basically amended their return, and the amended transcript wasn't returned to show the lender the full picture. But, you know, for something this minor, I mean, this was just the unintentional omission of a little bit of income and a little bit of job history. We were able to correct that, okay? But I do want to point out, when your approval is based on a work history that is continuous for a number of years, and then you change it by saying, oh, no, it hasn't been 4 years of continuous employment, there were 3 other jobs in the picture, you know, it could potentially create an approval issue.
Right.
You know,
so you can go from being fully approved, about ready to close escrow, like waiting to draw a lender package that you'll go to the title company to sign, to actually creating a denial for yourself.
Correct. Borrowers with lower credit scores that are getting underwriting approval are getting it based on compensating factors, and job stability is one of them. So you present the file that way with a stable job history, and then you change it. You know, it could potentially reverse the entire approval. It didn't in this case.
Right.
But that's why it's so important to just be as forthcoming as possible and let the people that are helping you with your loan determine what information is important and what is not.
Well, you know, my goal was just to bring this awareness to the person listening, that if someone's thinking about buying or selling a home and definitely getting a mortgage, and they're going to complete that loan application, whether it be by phone, online, or even handwrite it, make sure that you don't miss anything. And if you have any questions, just get with your loan officer and have them, you know, determine if you need to leave that off or how it needs to be structured on the application.
We're professionals in what we do, and you can't give us too much information. We're there to guide the process and make it a smooth one. And so understanding all of the details up front definitely does expedite the process.
Well, I mean, you're going to get them. You know what I mean? That's the bottom line, is you're going to get the details. So just disclose them now so that you can create any possible, issue with hiccups. You can deal with that now versus later.
That's exactly right.
So, I've been teasing the FHA Back to Work program because I think it's kind of a new program that a lot of people aren't aware of.
It is.
And I want to share on that because the FHA Back to Work program, this program applies to people that have had a short sale, a foreclosure, or a deed in lieu where they've just signed the house back to the bank. And so, Sarah, since you're the expert on this matter, I'm going to let you share about the FHA Back to Work program and what that means and what kind of buyer this is good for.
Okay. Well, the FHA Back to Work program is still your normal FHA loan. It's still a 3.5% down payment, 3.5% down payment that is required, and it works just like a normal FHA loan, with the exception of one underwriting rule that used to be the what would stop everyone. That your typical FHA loan would have a 3-year requirement for a foreclosure or short sale. Okay, the FHA Back to Work program relaxes that rule, and it's now 1 year. However, there are some stipulations.
You know, I said for a long time I knew that they would loosen the guidelines. They just had to. There was too many people that were affected by this.
So many were impacted, and they have since recovered, saved their money, improved their credit score, maintained their debt, and they're just completely stuck for that reason.
We've seen it, Sarah. I mean, there's a lot of people that, you know, even in our business, we've had to short sell their property because maybe they make double what they make now. And when the economy hit, it affected them and many people. So it's not like they intentionally didn't pay their bills. They just lost their ability to do so.
And that's the point of the rule I'm going to explain to you. In order to qualify for that program, you are going to be required to document that at the time that occurred, you experienced financial hardship. You experienced an income reduction of at least 25%. They don't want to see that, you know, you could more than budget for it and just didn't. That wouldn't qualify for the program. So,
you're referring to strategic defaults where people just, I'm upside down, I'd change my mind, I'm not going to make this mortgage payment anymore.
Right. Right, and the thing is that for the most part, it was out of the homeowner's control. It wasn't just the mortgage and real estate industry that was impacted. The economy as a whole was, and just about everyone suffered. So you have to be able to document that you did experience a financial hardship, and that's just typically done by way of tax returns, where they can see that you were earning less during that period of time.
Now, is there a percentage, Sarah, or a certain amount that you have to have earned less to qualify?
25%.
So 25%. Okay.
Mm-hmm. Yeah. And so in addition to that, and this is really critical to know, you have to go through their homebuyer educational process again. Now, this is a certificate that you can obtain with lots of different FHA-sponsored entities online. Some of them are for a small fee. Others are free. But you have to take that educational course with respect to home ownership, and it takes probably about 30 minutes to do.
Yeah, I thought that was interesting because that was a little part that we talked about earlier in the day, that this can literally change. It can make the difference between being approved for this program or not.
Right, and I'll tell you what's critical about that step. That needs to be done in advance, as in prior to a contract, prior to a loan application. They need to have already secured that certificate. And what happens is when this program, because it's very new, was first rolled out, folks were going into the program, they were becoming fully approved. They were getting, within a week of closing, and then they were asked for their certificate. And they would reply with, well, I didn't get it, but I'll go get it now. And the answer would be no. FHA doesn't allow it. They won't make an exception. You have to have that certificate in advance of shopping for a home or applying for a loan when we're going with the 1-year rule on a prior foreclosure or short sale.
Which 1 year goes by so fast. I mean, I can think of several people that I know that this program is going to help. And
right.
I mean, aside from that, if I can take a homeowner that had to do a short sale because of their position, but maybe, we taught them a little bit going through the process and they've saved some money and they've learned the impact
sure.
of, having a reserve fund and $1,000 emergency fund. Mm-hmm. They have learned from their mistakes, and they,
right.
Now their next home, they want to buy well below their means. So,
right.
You're talking about a payment in many cases that's less than what they're paying in rent.
In rent, exactly. A lot of hard lessons were learned, and a lot of people were put in positions that might not have been, anything in their control, and so it's made everyone just kind of scale back and become a little bit more conservative so that they don't have to experience that kind of stuff again.
And it makes sense from the lender's perspective that, they don't want the home buyer education to be an afterthought, meaning they
right.
want you to get this education first and go, hey, I really want to buy a home. What's the necessary steps that I have to do in order to do this because I had this short sale, foreclosure, or deed
right.
in lieu?
And it's a simple process. It's not challenging. You don't have to go sit in a class anywhere for 4 hours. It literally can be done online. But I will tell you, in the cases where, this new requirement was discovered at the end of the loan process, they literally had to stop, rewrite the contract. In some cases, it fell apart. In other cases, the sellers were willing to give another 30 days, but they had to start over because they do not bend the rule on that. So it's really important to just go ahead and get that certificate. It doesn't take long to do, and then you can use it. And the other important point I want to make is understand what your date is with respect to your prior short sale or foreclosure. You may feel like I lost my house, in last March. But it's actually the recording of that deed in lieu or that final judgment of foreclosure. That's the date that they move forward from. And, some of those things were held up in the county, depending on what county the property is in. And so we want to determine that exact date.
Great. I mean, I want to, there's some different things that I want to go into because, like you said, you do have to pay attention to those dates.
Right.
And we want to give the person listening information on how you can get that course. We have to take a very quick break because we're about quarter till in our process here, and I'm going to get cut off. So stick around for just a second, Sarah, because I want to dive into what the next part of that process is. Sure. And we're going to help some home buyers buy a home that had a foreclosure, short sale, or deed in lieu. We'll be back in just a minute. You're listening to Tampa Home Talk, and this is your host, Katrina Madewell. Stick around. We'd love to have you back for the end of our show. Good afternoon, and thanks for sticking around with us here at Tampa Home Talk. I'm your host, Katrina Madewell, and we strive to bring you a great show today. We wanted to share some little tidbits and things that we see, little quirky scenarios in the industry every day. So the next time you're ready to buy or sell a property, you can do it with ease and know that this is what we do every day. I know we were talking about the FHA Back to Work program, Sarah, before we had to take a quick break. So I just want to touch base on this because, again, there were many people that were impacted in the last several years since the meltdown in 2006. And, you know, they lost their job, whatever their situation was, and they literally had to do either a foreclosure, short sale, or a deed in lieu. And we'll talk about why those are better than not doing anything, because we were talking about how a lot of times those foreclosure sale dates, they linger. Like the people have already moved out because they haven't paid, but they linger, and that actual foreclosure date can maybe not be for many, many years after, correct?
It is, and it's very often incorrect on the credit report as well. You know, the applicant, the borrower, has an idea because they're notified of when their foreclosure is taking place, but, you know, there's a whole additional process that occurs through the court system before that's actually recorded. There are folks that, you know, were foreclosed on, you know, and 3 years went by before that foreclosure was actually recorded.
Yeah, that's craziness.
It happens, and you know, and the thing is that that's what makes a deed in lieu a little better. If you know, at the time, if you knew you were going to foreclose and you did a deed in lieu, you just expedited the process instead of waiting for it to go through all the changes.
Yeah, I mean, I would say if you're in that position, you obviously want to try a short sale first, because then you have control over the situation.
Correct.
You have control over your outcome, because we're a deficiency state. They can pursue you for the deficiency balance once they sell the foreclosed property again.
That is correct.
We're seeing a lot of these creep up now. I mean, we're seeing more and more of them start to pop up. And I've said that for years, that, you know, the banks are going to come back with a vengeance. They're going to sell this bad debt. They're going to come after the walkaways first. And we're starting to see that. I've had people reach out to me and ask me about that, and we referred them to some of our attorneys to help out.
Right.
So let's go back to this positive note with regards to the FHA Back to Work program. So after 1 year, if you've experienced this, you can, meet some certain criteria, which really isn't that strict, I didn't think.
It's not. Like I said, and that's why I started by explaining this is just a regular FHA loan, okay? It's just got two additional requirements. You needed to have experienced some financial hardship, and that needs to be a decrease in income of at least 25% at the time you lost your home. And you need to take a home buyer educational course in order to buy your next home. Yeah,
so the lender and the government want to make sure that it's a make sense type loan, which makes sense. I mean, it's common sense, finally.
Exactly.
Now, the home buyer education, is there any restrictions on that? Does it just have to be a certified one? Because I know we do a lot of stuff with Salidas House, and I would imagine it has to be a HUD certified.
They have to be HUD approved. FHA has a website that will list every HUD approved education
counseling agency. Yeah,
exactly. Yeah, they have a list of them. But also, I mean, you know, we deal with MGIC, which is a private mortgage insurance carrier, and they're HUD approved, and their site has a nice link that you can click in and, like I said, participate in the educational course. It takes about 30 minutes, and it'll print you a certificate, and that's valid and acceptable to FHA.
And that's online.
It's online and it's free.
Yeah. And so it works in a pinch, you know, and if you want to go a little step further just to make sure you're prepared, we work a lot with Salidas House, which is a nonprofit HUD counseling agency. They help with a lot of these things as well as foreclosure intervention, and we're happy to, you know, refer people to them when they need. If we can help somebody save their house versus foreclosure short sale, then we're certainly going to do it every time.
Absolutely.
Well, thanks for chiming in and talking about the importance of a fully disclosed complete loan application, as well as the FHA Back to Work program. It's an excellent program. We're going to help a lot of people take advantage of that. And I'm going to leave you with our off-air number in case you have any questions on this program or you want to connect with myself or Sarah Crickey. And that's 813-936-2302. 813-936-2302. That's our off-air number. And again, that's 813-936-2302. And we'll be happy to connect with you and give you information on the program. Thanks so much for chiming in today, Sarah.
Oh, it's my pleasure, and I can't wait to talk to you next time.
Fantastic. Have a good day. Thanks.
You too.
So the next part of our show, we're going to get into the Money Matter segment. In the Money Matter segment, we like to just share on the next piece of it. So our show mission is to help you keep and maintain good credit, live within your means, very important, and build your wealth. And we have a guest I know that's chiming in. Is he already on the line, Cedric? Okay, so Andy Feinberg. Am I saying it correctly, Andy?
Hello.
Hi, good afternoon. Thanks for chiming in.
Good to be here.
Now, you're a columnist for Kiplinger's, correct?
Correct.
And that's for a long time.
Yeah, for 12 years, and that's as long as I've managed money professionally as well.
And so tell me a little bit about yourself. You're a professional money manager. I know you've written 5 books.
Right. I've written about personal finance for over 30 years and for many different magazines and written books on it. And I became a professional money manager, as I said, 12 years ago and started a hedge fund 6.5 years ago called CJA Partners. And I've beaten the market by 4% a year for the last 12 years. So it's worked out.
That's awesome. And so you're helping your clients from people maybe that are getting started to obviously hedge funds are way more seasoned investors or the people that are, backing and putting this stuff together.
Well, it's a real mix. And some of the... my minimum is $50,000, and some of the people are, 35 years old and 40 years old. They're saving, for college. They're saving for retirement. And, hedge funds, I think, have a bad reputation in several ways. One, people who might benefit from them think they're off limits, that they're too expensive and their fees are too high, and often their fees are too high. I gotta tell you that from a real estate perspective, Andy, we love the hedge funds, and I think a lot of people should also love the hedge funds, and I'm going to tell you why. The hedge funds are still here, buying properties in our market, and it's a good sign. They help clean up a lot of the crap, a lot of the extra inventory that we had, and they help bring real buyers and investors back into the market. There's no doubt in the markets that were hardest hit, they saw value, and they stabilized the markets, and as you said, encouraged other people to come in.
Right.
Because they were not in free fall any longer.
Yeah, it follows. At some point when you start looking at those cap rates and for what they could pick up some of these properties for a couple years ago, it was absolutely ridiculous. And so when you look at that return on investment for renting it, it's no wonder. I'm just surprised they didn't come in a little sooner.
Yeah, well, I think they were. I'm surprised too. One of my largest holding is Howard Hughes Corp. And they own a huge amount of land around Las Vegas. And, Florida, Arizona, Nevada were just decimated by the real estate.
California's in that little bubble, too.
Well, I'm sorry?
California's in that little grouping,
California too. Excuse me. I should not have left them out.
They're the ringleaders, aren't they?
Yeah, but they're... and I own a stock that owns a lot of raw land in California, and it's also a home builder, and they have land that they bought in 2008 and 2009, and they are sitting on it, and it's starting to appreciate.
Well, they don't make any more land. I remember my great-grandmother telling me that from the time I was a kid. They're not going to make any more land. And,
absolutely.
Time value of money, it will always make money in the end.
And I live in Manhattan, and it's crazy here that,
Your guys' idea of land is an alley, right, that you can convert to a studio?
That's right. And so my 28-year-old daughter lives in Brooklyn. Like all the smart young people live in Brooklyn because they can't, and they live with lots of other people.
Right.
Like my daughter lives in a brownstone with 5 other people, and they can't afford Manhattan, and it's...
Well, I know you guys have had a brutal winter, and we got a lot of sunshine to go around, so if they're looking for a little bit more space, we can help them out. So one of the things you and I talked about before the show was talking about what type of an investor you are and your threshold. Can you chime in on that the last couple minutes of our show?
Yeah. Well, two things. one of my pet peeves on investing is that people don't understand what they are actually doing. They don't take inventory. They don't see what their risk tolerance is. They don't, can I stick to my equity allocation when, the market tanks? And so many people don't. And, there's so many stories about people who sold out in 2008, early 2009, and now they're getting back in, and that's just
bad advice,
not
isn't
a
it?
good strategy.
That sounds like bad advice to me.
Right. But the other thing with mutual fund investors, one of the perhaps the worst thing they do is chase funds that have done well in the last 1, 2, or 3 years, and then if those funds start doing badly, they sell and they go into other funds that have done well in the last 1, 2, or 3 years, and then those don't do so well. And the problem is they're missing out on the fact that there's a natural cyclicality in the market that is, alas, not very predictable.
Right.
And, energy will be strong for a while. Home builders will be strong. And
Andy, we got about 30 seconds because time goes by so fast when you're having fun. What would your big takeaway be for that?
My big takeaway would be, one, a lot of people should just be in index funds and stay in them. But if it's a good fund, don't sell it when it starts turning down, because it's a cyclical, usually it is a cyclical, the style of the manager goes out of, imagine Bill Miller, 15 great years, and then, 4 or 5 bad ones, and now he's doing well again. And if you got in at the very end and then wrote him down and then sold, that's the strategy that really doesn't work.
Gotcha. Well, Andy, we're certainly going to have you back on our show here on Tampa Home Talk. You're listening to Tampa Home Talk. This is your host, Katrina Madewell. Andy, thanks so much for sharing on our Money Matters segment today. We're going to have you back for a much bigger chunk of the show in future weeks. Thank you so much, and have a fantastic afternoon. You're listening to Tampa Home Talk. Catch us on across the web at tampahometalk.com, Facebook, and Twitter. We'll be here every Thursdays and Saturdays at 5 p.m. But for this week, we are out.